Alright guys, thanks for joining us. Apologies for being late. I was actually mixed up in some yen trades in my hotel room about 5 minutes ago. I'm afraid to ask this, but in Chicago, who's trading spot foreign exchange? Because I know this is Futures Time USA. Anybody trading the spot market? Okay. Any distinct reasons as to why we haven't opened a Forex account yet? Throw it up there. We're going to be talking back and forth, so might as well get it open now.
I need some knowledge. I would trade just equity options.
Okay.
What's called?
Okay. So let me just, before we get over there, what's your time frame? How long would you hold a trade?
Sometimes hours. I'd like to stay days, but
You could be in and out intraday. Okay.
Yeah, I don't have a lot of choice in some cases.
Yeah.
At the most,
Especially now. Yeah. Okay. I just want to get a feel for how we can best, use our hour and a half here to understand your trading tendencies, sir. Okay, good. Good. Short term, long term?
Depends on the
Dollar crosses? Okay. Anybody else?
Yeah, I'm looking at Forex. Because I like the idea of being able to trade it on the day.
Yeah.
Like to look at very short term and then take that with some more long term.
Okay. Good. Well, it helps me understand. As I said, I just want to use the best time we can. I'm a newcomer to this company. I'm happy to be here. So I'm coming to you from New York City. With Forex.com, I represent the spot foreign exchange market. I read a daily research piece called Strategy of the Day. It's published on our trading platform. What I've done is I've actually melded my research responsibilities into my next phase at Gain Capital, which is I got hired as one of the 9 traders on our asset management program. So what I've done over the last 5 years with Gain Capital is meld the two into one responsibility. Okay? It's my belief in this market, especially this market, guys. This is a volatile, extremely emotional, lookout market. Okay? So what I've done in Strategy of the Day is essentially write my research. What I do every single day is write my research, tell clients what I'm doing, where I'm in, where I'm out, present my reasons, try to give at least 3 good reasons to be in the trade at least 3 hours ahead of time. Okay? The spot foreign exchange market is the most liquid market in the world. So I have no problem giving clients my complete entry, exit, every step of the process. I try to put the trade out 3 hours ahead of time for thousands of people to read before I actually put the trade to work in the managed accounts. I've found that by thinking ahead and forcing yourself to commit on paper to thousands of people to read what your trade process is going to be, you have a very hard time breaking your own rules. Okay? I believe it doesn't matter how short term you get, you should be able to see the trade, a real trade. If you're going to put size on the trade, you should be able to see it at least 2 hours ahead of time. Okay? If anybody's more short term than that, if you're a true scalper, let me know. But it's my belief, if you're holding trades for more than 15 minutes, 20 minutes, 30 minutes, 2 days, you should be able to see the trade a couple hours ahead of time. So I found a new life in my trading. Okay? I've been trading for 10 years now. In the last 3 years, I've really found that the best trades that I do were written hours ahead before they actually go on. I also have another rule. I can't do larger than 50% of my full size. I'm allotted a certain size that I can trade on the fund unless I've written about it in Strategy of the Day. So why am I telling you this? Because my specific way of looking at the markets, my form of technical analysis, my kitchen is Elliott wave and Fibonacci analysis. Okay? It's a great methodology provided you learn the rules. There's 13 patterns. That's all that exists in Elliott wave. There's 13 patterns. If you can essentially follow the rules of Elliott wave is going to keep you in the trend of the market, with the trend of the market, until such time that there's a very good reason to fight it. Okay? What better methodology is that? Elliott wave is essentially a trend-following methodology. Okay? Fibonacci overlaid on top of Elliott wave is going to dial in your entries. Okay? And that's what we're going to look at today. Okay, and we went through that. Okay, what are we going to cover here? We're going to cover psychology. Elliott wave, and especially in this volatile market, our goal right now is we're going to exploit market emotions while you control yours. That's the whole name of the game in trading. And as your size gets larger, as the account size gets larger, as your trade size gets larger, those emotions inherently are going to increase. So you need to tackle that now. If you're trading a smaller account you envision getting larger in the future, you're going to have to dial in and be comfortable with the methodology that's going to allow you to act without hesitation when your size doubles, triples, or quadruples. Okay? Analysis. So you power your trading with fuel. Okay? FEWL, Fibonacci and Elliott wave levels. My marketing department hates this because they think it spells fool, but I think it spells fuel. Okay, we're gonna look at some actual trade walkthroughs and strategy of the day, which is my research piece, and we're gonna do a book giveaway. Okay, this Elliott Wave Principles book, written by Robert Prechter back in 1979, 78, I think is essentially all I need to trade. I've read the book about 5 times and I understand about half of it. But it's a great book. Okay, so what we're going to do is, unfortunately the books did not make it, so what I'm going to do is there's going to be a book giveaway. Every time you see a question, every time you see an icon, answer the question on that slide with the book, you're going to get the book. Got to give me your name and address and I'll mail you the book. Okay? You read that book before?
Well, I've read it through the first time.
Okay. You got 4 more to go.
Exactly. At least 3 more, I'll tell you that.
Yeah, it's written in a very academic manner, but as far as I'm concerned, a couple psychology books, a couple philosophy books, and that right there, and that's what you need to trade. Okay, it's not easy. It's an interesting read, but it's not easy. Trading is not easy. Okay, for me, it's not for everybody. For me, it makes sense. The way that I know myself, I've identified myself, I tackle my emotions. I know I'm hyper. I know I'm all over the place. Elliott Wave gives me a strict set of rules. It's not a system, but there's a couple rules that you cannot break that will keep you in the direction of the trend until such time there's a great reason to fight it. Okay, if you guys have questions, please shoot them out there. I have no problem answering them as we go. Okay, mainstream investment psychology. Okay, masses invest with less than all the facts, especially now. Do we have any idea what's going on in this economy right now? Is there any fundamentalists, economists who can certifiably say they know what's going on? Deflationary markets such as we have right now haven't happened since the 30s. Okay, it's a different economy compared to 1930. Okay, so we don't know what's going on. Okay, and investment decisions are obviously being made by people. Look at the 700-800 point swings in the Dow right now. Look at the 6% move in dollar against the yen right now. People are making moves. Granted, it's a less liquid market than it was 2 years ago, but people are making moves, and the problem is we're doing it best on information that is incomplete. We don't fully understand what's going on. So what happens is when investors and traders alike are making decisions based on less than all the facts, what do we start doing? How do we make an investment decision? You look over at your neighbor, you read what's going on in the newspaper, you look at the TV, if you make it even worse just on emotion, what your feeling is. Okay, that creates a herd mentality. Okay, and your emotional reaction to a 600-point move in the Dow is most likely going to be similar to his reaction and to her reaction. And all of a sudden we have herd mentality driving the markets based on less than all the facts. Herd mentality creates identifiable patterns in the market. Elliott Wave has identified 13 of them. And that's what we're here to exploit. Crowd following. Sad but true fact, people spend more time researching their vacation spot for next year than their investment choice. That's my point. I don't need to say anything else besides that. Okay, so let's do a little self-monitoring. Let's take a look at our investment psychology, or trader psychology. Okay, there's going to be 2 sides. You're going to have a series of winning trades. You're going to have a series of losing trades. It's very important that you self-monitor in both situations. Okay, what happens when you've hit 5 trades in a row? I mean, obviously you're feeling invincible. Normally I'm a 20-lot trader. All of a sudden I'm doing 40. And then I get wiped out. Wait a minute. Hold on. Was I prepared to do that? Did I know I was going to do that trade 3 hours ahead of time? Okay? Holding losers too wrong. Holding losers too long. Okay? If we're used to being right 5 times in a row and all of a sudden trade goes against you, you say, wait a minute, this isn't right. I'm on a roll. It's coming back. Take your stop, move your stop, cancel your stop, whatever, and then you wipe out all the work you've done in 5 trades. Take outsized risk. Too many trades, too many other markets. I'm a euro-dollar trader and a dollar-yen trader. Now, if all of a sudden I'm trading 40 lots in sterling yen, and I have no knowledge of where that market's been, I'm getting a little ahead of myself, so easy. Okay? Or on the other side, losing streaks. Maybe you've had 5 losing trades in a row. Okay? But then the pattern, based on your methodology, sets up, and you're a 20-lot trader, and all of a sudden you take 5 lots on a great setup. Well, now you're doubting your methodology. Don't do it. Cutting winners short. Okay? You just for the sake of being right. You know, we're all emotional creatures. We really have a need. We've been taught by society that we're supposed to be right in our workplace. It's not our job to be wrong. If you're wrong, you get scolded. If you're wrong too many times, you get fired. The job of a trader is to be wrong often for a very little amount, but then right consistently for a big amount. Okay? So don't cut winners short just for the sake of being right. Okay? If you want to be a trader, if you want to be a successful trader, you got to get over the need to be right. You got to let go of your ego. Take too little risk, hesitate in the entry. There's really no reason for this. If you subscribe to my methodology, and I'm not saying you have to, I'm not even encouraging you. I want you to seek it out because it's not for everybody. Okay? But if you do subscribe to my methodology, you're going to find the entries are very well defined. And you know not only within a zone where you should get in, you should know the exact price where you want to get in. I command my price. If I don't get my price, if I miss it by 5 points and the market goes 100 in my favor, that's fine. I don't ever want to chase an entry. I'm a limit trader, meaning I will stick limits. I'll call my bank and I'll say I'm a seller at this price, right at this price. It's how many times has it gone 2 points against my entry or 2 points shy of my entry and then collapsed? I don't mind that. I want my entry every time. Okay, here we go. Let's get into fuel. Fibonacci. Einstein says God does not play dice with the universe, meaning there is a natural order to the universe. There is a natural order to human psychology, which is reflected in the stock market, in financial markets. Okay, that was Elliott's key driver of the Elliott wave theory, is that the stock market is the truest barometer of human growth. Almost every low point in the stock market in human evolution has been accompanied by a war. After that, the markets recover. Human progress recovers in what follows the equity market. So there is a pattern. It is not a random walk. Seemingly random chaotic structures actually have order when you look at them in the right way. Seemingly random price structures have order when you look at them in the right way. Okay, so Fibonacci. Fibonacci ratio, 1.618, helps to understand seemingly random occurrences such as social progress. Social progress is not random. As I said, almost every low point in society over the last couple thousand years has been accompanied by a war. After that, civilization rebounds, as does the financial markets. Okay? Social progress or market performance, neither of them are random. Okay? Recurring growth ratio consistently observed in both, 1.618. And our job here is to figure out how to look at the markets in terms of this reoccurring ratio. Okay, Euro-Yen on the daily. Take the move X, doesn't matter what the distance is, multiply it by 1.618, and you're going to get the exact low, 154. We're a bit lower now in the Euro-Yen cross. Okay, Dollar-Yen on the 45-minute, did a simple 618 retracement before he bounced higher. Okay, here are the Fibonacci ratios. If you guys want me to mail this, here's the ratios. I'm not going to go through them. If you want them, you can email me and I'll send you the ratios. The two you want to concentrate on are obviously the phi and the inverse of phi, which is 0.618. Okay, so how do we calculate Fib? That's the biggest question. Anybody a non-believer in Fibonacci? And tell me if you don't believe in it. Everyone believes in Fibonacci here. Yes? Oh. I was kind of hoping somebody would say no. Then I get to tell my joke. Usually when I ask that question, 38.2% of the people in the room say yes, and 61.8% of the people say no. Okay. The other thing, I was kind of hoping somebody would say we don't believe in Fibonacci, so this is an easy room. I would say if you don't believe in Fibonacci, I would say you're only using retracements, measuring the direction of the trend, measuring the correction within the trend, and I would say I'd agree with you. If you're only using retracements of Fibonacci, you're going to have a hard time doing anything. So what we're going to do is combine all the tools of Fibonacci. So the next question from there is, where do you start? Where on the price chart do you calculate your retracements, extensions, and projections? Well, first thing you got to identify a trend. Then you got to identify a correction. This is technical analysis 101, but this is important. Okay, what's the trend of this market? Up. Okay, so all trend legs are obviously going to be heading to the top right, and all corrective legs are going to be heading to the bottom right. So we need to identify within our trending market trends and corrections. From here, we can start building our Fibonacci ratios. Okay, so number one, retracements. Identify a completed trend wave. This trend is obviously down. So we know we're trying to estimate with a retracement how far the correction is going to be before the longer term trend reasserts itself. Okay? Identify the swing points of our trend. Swing point 1, swing point 2. This is where we're going to capture our Fibonacci retracements. Anticipate a corrective wave after our trend. Okay? We're going to overlay the Fibonacci retracements. Okay? Now on e-signal trade station, anybody else using a different charting software? What are you using? Metastock? Okay. Yeah, they'll all appear the same. Okay, you're going to have your retracements are 23.6, 38, 50, 618, and 786. I just put up the 50% retracement just for simplicity. What was your question, sir?
1 over 0.2, that's just the actual high and that's just the low, right?
Absolutely, the high and low of your studied trend leg. If we go back to this one, just take any, if you can see it, any of the
High, any low.
any high, any low in the direction of the trend, the beginning of your trend leg and the end of your trend leg. Okay? Markets, we know that markets don't move in one direction. They don't go in a straight line. What do? Markets break out, buy stop, momentum entries, push markets to new high. At some point, greed is going to take over within the trend of the market. Longs are going to start exiting their positions. A new short selling interest comes into the market, pushes the price back. Those shorts begin to take profit. New momentum, pullback traders get in the market and push the markets to new high. So my job, or your job, if you so choose, as a short-term trader, is to not be in, for me, is to not be in the trend from here to here. For me, on a 60-minute chart, a 180-minute chart, there's about 4 trades in here, in the direction of the trend. I had a nice conversation with the turtle trader last night at dinner, and we got into it a little bit. We got into it. It was a very friendly debate. And I'm not going to go into it. It's just for us. But I just made the case that for me, in my mentality, and the way that I adapt and the way I deal with profits in the market, I don't want to sit through these corrections. It's not in my makeup. I want to be out. I want to get out of longs, reestablish down here, start taking profits into the push higher, look to reestablish. Okay?
On the 60-minute chart.
Whatever. We can get into that in a sec. But yeah, we're going to use all time frames. So your job within that. So how many legs did we get in that move? We got 1 yellow bar, 2 yellow bars, 3 yellow bars, 4 yellow bars. Okay. In this whole move, we've got 4 trades. Our job is to anticipate when those open shorts begin to come in and take profit, and pullback longs start entering the market. That's when the correction is going to end, and the longer-term trend is going to reassert itself. That's for me. That's where I want to dial in my entries. And you use that within those 4 entries within the trend. You're going to use your retracement tool. Identify the beginning and the ending of each of the 4 pushes within that trend we saw in the last leg. Does that make sense, sir? Okay. I know I way over answered that one, but go ahead.
Are you picking point 2? When I look at that, I can see that the low previous to that could be a 5, end of a 5 there.
Okay. So you were. I could see a little 1 here, sure. You're jumping way ahead, but it's a great point. Absolutely. If you can count 5 waves, that's even more of an indication that this is the end of your short-term swing.
No, but I would argue it might be the point before that.
Let's get into that. Let's get into that. I don't want to get too far ahead, but I totally see where you're going with this. And the short answer is we're on a 120-minute chart. You need to be looking at the 240, 360, 720. Get the context of the larger count. And you absolutely could be right. But you know what? There's only, within the context, if this is a 100-point move, you're only talking about 8, 9, 12 pips within this overshoot of your 3 to 5. So, all right. So let's keep going. Drop the retracements, 50% retracement, boom, moves lower. Okay? Number 2, that's extensions. So a retracement, you need the endpoints of a trend leg to anticipate how far the correction is going to go before the longer-term trend reasserts itself. That's nothing more than trading with the direction of the trend. You're a pullback trader in the direction of the trend. You can be a stochastic cross, a MACD cross, buy a pullback to support, whatever. That's just the most simple and most effective way to trade is buy pullbacks in the course of the longer-term uptrend and sell rallies in the course of longer-term downtrend. So corrections are measured by retracements. Okay, now extensions. We identified a completed trend leg and used retracements. In extensions, you're going to identify a completed corrective leg. Okay? After we identify a completed corrective leg, you're going to anticipate what? I've said it 8 times. The longer term trend is going to reassert itself. Okay? What's that? Mm-hmm.
And you are, from assuming you hit the bottom, you identify where you think you hit kind of
You're talking about extensions. Yep, she's basically she just defined what we're going to talk about with extensions. You guys are all steps ahead of me here. I might need to kick it up here. Okay, so absolutely. Within the course of the longer term trend, we can identify the trend in this market's up. So the cursor, I'm running my cursor over the uptrending part of this chart. The correction sets in, and we're going to anticipate the longer term trend is going to move higher. So once we can identify the corrective wave is complete, to use extensions, you're going to click the the beginning point of the correction and the end point of the correction, and you're going to anticipate how far the trend is going to move. So what that is going to look like is this. Okay? You're going to click with your Metastock, with your e-signal, and your trade station. You're going to click the beginning of the correction right here. You're going to click the end of the correction here. This distance, say it's 100 points, is multiplied by 0.618, is multiplied by 100%, it's multiplied by 161.8%, up to 2 and 2.618. Okay? So from here, an extension is going to measure or project how far a trend move is going to go. And these are your possible extension ratios, 1.272, 1.618, and 2 and 2.618. So, first book question. All right, does everyone feel okay before we start dealing books? Is everyone cool with retracements and extensions? Go ahead.
Are you saying then that from the actual correction all the way down to the end of it, you can use Fibonacci to go up and then see what the actual projected is?
Absolutely. You can. That's what I'm saying. That's why I was hoping somebody would say I don't believe in Fibonacci, because I'm saying you're not using all the tool. Wait, say that again?
I don't believe in Fibonacci, educate me.
Thank you. Thanks for humoring me. Okay. Trend of this market is up, agreed?
Correct.
Okay. So this is what? This is the trend wave.
Correct.
This is a corrective wave.
Correct.
This is the trend wave. Retracements, I want the beginning point of a trend wave and the end point of a trend wave to anticipate how far this correction is going to last before we move higher. So what does a retracement do? A retracement gets you in the trade in the direction of the trend. An extension, once this corrective wave right here is complete and the market begins moving higher, you're only going to know in hindsight that this is a corrective wave. And that's fine. With an extension, what you're going to do is you're going to click the end point of the beginning point of your correction, the end point of your correction, and it's going to put out the different ratios. You're going to take this distance right here, your corrective distance, and you're going to break it up into 0.618, 1, 1.618, 2, and 2.618. From here, you're going to project this distance is going to be projected higher this way. So from this point to this point, this is 200% of this move. So what we're doing with Fibonacci is you're taking the distance of this move to calculate a retracement. You're taking the distance of this move to calculate an extension. What we're doing is we're taking the temperature of all the different price legs involved in the move. In the next one, let's do a book question, and then the third example is going to combine those two, and it might make sense. So, trend of this market is down. Obviously, this is the corrective leg. Here's the beginning point of a correction. Here's the end point of a correction. That's what we're going to use to put our extensions together. This move is 231 points. Okay, the corrective distance was 231 points. The market moved to new lows. The market pushed 143 points lower before we put in a double bottom. Which fib extension is this? And I need a hand. It's the only way I can get the... Oh, that was close. 1.618.
How'd you get that?
That's exactly right. Okay. It's less than double.
Yes, but it's more than 100%.
It's more than 100. Well, it's actually just 618. Okay?
Yeah.
It's actually 618, which is 1618. So this is 231 points. And if you divide it by 618, you're going to get 143 points. That's exactly right. So I'm going to please come up and give me when you guys answer a question, give me your name and address, and I'll email it out. So it's 161.8%. So that's exactly right. Does that make sense?
Yes.
Okay. Now we're just going to take the two things we did and put them together in projection. Okay. We measured a trend leg to get retracements. We measured a corrective leg to get extensions. Now the third and most powerful tool in Fibonacci is we're going to combine both corrective and retracement to get a target. Okay, and that's a Fibonacci projection. Who uses e-signal out there? Anybody? Okay, good. That's fine. eSignal improperly labels it as an extension if you get on the eSignal platform. It should be a projection, but... Okay, so as I just said, we're going to identify completed trend wave, identify completed corrective leg, anticipate the longer-term trend is going to reemerge. So we've got two pieces of information. We've got a trend leg, we've got a corrective leg, and you're going to anticipate that the longer-term trend is going to reassert itself. So we have 3 endpoints now, right? We have 3 known distances. We have the beginning of the trend, the end of the trend. Actually 4. The beginning of the correction, the end of the correction. So with a projection, we're going to take the knowledge of both distances to project how far this move is going to go. Okay, so here are your 3 endpoints, A, B, C. And what you're going to do is you're going to click 3 times. An eSignal trade station, you're going to click once, you're going to click twice, and you're going to click 3 times. All this is doing is with a projection, if you discover that this move is 100 points, it's going to take 100 points to project it from the end of the correction. So equality would be somewhere up here compared to this move. 618 would be somewhere down here. And 1.618 would be somewhere up here. So now what you're doing is you're using the distance of all your legs to pinpoint where your entries and where exits are going to be. Possible ratios from projections are 6181, 16182, and 2618.
So when you do that on your computer,
Mm-hmm.
you need to basically click the mouse 3 times to have the actual computer project.
Yes. Yes. You click 3 times. What? What are you thinking?
I've only clicked it twice and I didn't fucking do it 3 times.
You do it 3 times.
Okay.
Fibonacci's, when you start using all the tools, and what we're going to do is within the Elliott wave count, we're going to use all 3 of those tools, and when you get agreement within a very tight zone, within the context of the wave count, that's how you're going to see your entries 3 or 4 hours ahead of time. That's going to be, I want that price. And this is what I do all day long, and I love it. All right, so here we go. Can you find the fib projections? So the first move, and I think you asked me, you should be able to pick up on this pretty quickly. First move in the new trend was 155 points. We got a little correction, which is probably a wave. Sorry for pointing at you. 2. Okay, good. So we got a first wave down. We got a second wave up. So we have 3 known points now. We have the beginning of the trend, the end of the trend. The beginning of the correction, the end of the correction. Take 155 points, multiply it by 0.618, 100%, 161.2, and then 2.618. Project it down. So this is 155 points. And from here, once we projected lower, this move went 405 points. Which fib ratio projected this low? 6181? No, you got to raise your hand. All right, I got to give it to her. I'm sorry. She's working hard up here. You're absolutely correct. 2.618.
Do you ever take a 38% retracement to figure out the correction?
Wave 2, absolutely.
First wave, you get a...
Absolutely.
Okay.
Very common. Actually, you know what? And sorry for jumping ahead because we haven't gotten Elliott wave. 38% is more common in a wave 4 than it is in a wave 2.
Okay.
But very good point.
So you're saying 2.6 wave based on Elliott wave or...
Who understands the basic? You guys are dying to jump ahead. This is based on Fibonacci, but we're trading fuel here. Fibonacci Elliott wave levels. We're combining them.
Fibonacci will have a level before that as well.
Say that again.
Fibonacci will have a level which will be before this as well.
Before the 2618? Yeah. Many times. Okay, who understands the basic? I'll answer this question. Who understands the basic concept of Elliott wave? Markets move in 5 waves. You guys are all somewhat on board that?
Yeah.
Okay. No. Are you just telling me that? I asked for it too.
Count the waves for me.
Okay.
2, 3, 4, 5.
Markets, the most simplest, if you break progression down to the most simplest form, a market can't progress without in any less than 5 waves. Okay? You're going to have 3 steps forward intersected by 2 steps back. That is progress at its most basic level. So Elliott, on all scales, identified that the markets trend in 5s. 1 trend, 2 correction. 3 trend, 4 correction, 5 trend before the market retraces. Does it always happen? No. Does it happen enough to give you some kind of identifiable edge? Yes. And when you overlay Fibonacci on top of Elliott wave, you can pinpoint your entries into such tight levels that your stop losses wind up being a fraction of your anticipated take profit targets. In a 2.618 projection situation like we have here, this is most often a wave 5 target. This is the most common wave 5 target. If you take the distance of wave 1 and multiply it by 261.8%, okay, many times that's your wave 5 target. And when you can count a 5-wave situation within that target, okay, that's when you're going to start getting aggressive. And that's what I'm saying. Elliott wave will keep you in the direction of the trend until such time that you have a very good reason to fight it. And when you start seeing, we only put two tools together. It would take me four more criterion to step in here and to buy this low. Okay? Charging ahead? Okay. Now, EW of our fuel trading system, that's Mr. Ralph Nelson Elliott. Died in 1934. Made it just long enough to get through the crash. He actually perfected and really worked on his Elliott wave theory once he was kind of decapacitated later in life, and worked on it right until his death. And there's many people, including Robert Prechter, living on today who are pursuing the study. It's been it's made a world of difference in my trading. As I said, a lot of people haven't taken the time to understand it, so they shun it, which is fine. As I said, it's not for everybody. But I would highly recommend reading that Elliott wave theory book. It's a great read. Okay, so Elliott wave principles. Markets unfold in trends of 5. They retrace the trends and correction of 3 waves. So the markets advance in 5s, correct in 3s. Advance in 5s, correct in 3s. How do you know, or how do you get the inclination that we might be at a market low? Well, so we've seen 5 waves down, 3 up, 5 down, 3 up, 5 down, 3 up, 5 down, 3 up, and then all of a sudden you see 5 little waves up. It's picking the bottom of a market starts just like that. As soon as you start seeing, on the smallest degree, 5 waves up, something could be changing. Then you start looking back into the count, look for the relationships, look at the Fibonacci ratios, and you say, could this be the bottom of a market? And the great thing is, if you determine that it could be the bottom of the market, your risk is very clearly defined, as we're going to get in here in a second. So if your risk is very clearly defined, you know the market should not move below your projected low right now. Okay, this becomes your stop loss. All right, so I'm getting a bit ahead of myself, but let's get into the basics here. So markets trend in 5s, correct in 3s. Trends can never be 3s, correctives can never be 5s. There's only 13 different patterns in the Elliott wave universe, and 8 of the 13 are corrections. All right. This is an actual Elliott wave progression. Talking fundamentally, I'll just take you through the sequence. This is euro-dollar since the 2001 low. Okay. To those who are new to currency trading, the euro right here, as we're going to 0.85, 0.9, if you can't see the scale, up to 1, up to the recent high of 164. The euro is strengthening, the dollar is weakening. And the psychology that's involved within a 5-wave sequence on the longer time frame can be applied to any market. It can be commodities or equities or currencies or real estate, interest rates, whatever you trade. So I'll take you through the story very quickly here. During 97, 98, 99, and 2000, what was going on in the U.S.? NASDAQ was going crazy. Okay, bubbles going crazy. The Fed's hiking interest rates. So between a strong technology market, increasing interest rates, that's the primary driver of the currency markets. The higher an interest rate a country will pay, the more money will flow to that country from abroad. So the euro-dollar chart had been moving down because the dollar was strengthening. All of a sudden, and halfway through 2000, you know, the NASDAQ topped in March of 2000. Things started to change. We got our first little rally. Okay, so what's going on is, as this chart's moving higher, the dollar's moving lower. Euro's moving higher. So we're going to talk about fundamentals in terms of the euro. At this point, in March of 2000, April 2000, halfway through, the fundamentals for Europe were very poor. Okay, investors are very bearish. People are heavily short the euro. And we'd expect a move to new lows, especially with the euphoria that was going on in the NASDAQ. There's no reason to own euros. We want to own dollars. We want to own technology in the U.S. All of a sudden, you got the first little inclination. You got a 5-wave rally off the low. The market's heavily short. Okay? The markets are fully bearish on euro, bullish on dollar. We highly anticipate a return and a break to new lows. All of a sudden, we put in a nice deep retracement here, and it wound up being 3 waves. Okay? Most often in a wave 2 situation, it'll be between 61.8% and 78.6% of the previous wave 1 rally. Investors, once we get that deep retracement in wave 2, everyone's saying, yep, technology's on, dollar strong, sell euro, but all of a sudden, momentum wanes, volume dries up as we reapproach the lows, shorts start getting a little nervous, we start covering, euros come in. All of a sudden, big players come in, they identify the fundamentals are turning in Europe, though it's unbeknownst to the investing public, we get another rally up here in wave 1. We pull back again, and retail, slower, latecomers are thinking, yep, we're still going to the lows, but that's all of a sudden when the stops start going off, big buyers come in, and we push through these old wave 1 lows. So now we start getting short covering rallies. Okay, we start getting momentum breakout buyers. This is what draws a wave 3. Wave 3s are most often the strongest and most powerful wave. Strong, deliberate, extended price action. The fundamentals start increasing as we break through these old wave 1 highs. Within wave 3, most often there's a clear 5-wave subdivision. So once we move to the top of wave 3, momentum's at its highest. Fundamentals have completely improved. They've reversed, and the market has gone bullish of euro, bearish of dollars. We get most often an elongated and a shallow 4th wave. This is not the best example of a 4th wave. Many times a 4th wave will fall into a triangle pattern or some kind of long extension as the market if people are trying to play the breakout from the next move. You know, as everyone's trying to play a breakout, usually what happens is it's reversed. Because traders who have been long of euro in the wave 3 are offering supply into these old wave 3 highs. So they've got sell orders into the wave 3 highs. So most often wave 4 takes a long time to break. People who missed the wave 3 rally are trying to get on board in this wave 5 situation. But what they don't notice is the fundamentals have begun to shift away from the euro and back towards the dollar. So in a wave 5 situation, you're going to see late coming longs, you're going to see overly bullish news confirming price action. Very, very seldom will you see bearish fundamental news on a strong acting market that's at its highs. But if you really look at the information, you're going to notice that fundamentals, as we break out in wave 5, were not quite as strong as they were in the wave 3 situation. You look at your volumes, it's most likely lower. You look at your momentum indicators like RSI, momentum, stochastics, MACD. Most often there'll be a divergence in this 5th wave situation. So after you can count 5 waves, after we've gone through this whole psychological process of a market breakout, is when we're going to reverse either in 3 before the new wave and the whole new process starts, or we reverse all the way back down to the lows. Okay? This sort of behavior can be identified anything as short as an hourly chart. You can see an hourly chart, you can see the information. If you're watching closely in the foreign exchange markets, you can see the flow of information filtered through a wave count. And when you can overlay the psychology of a wave count with your retracements and with your wave counts, that's how you start getting that's how you get conviction in a trade. That's how you increase your size. That's how you say, you know what, maybe a 20-lot trader, I'm going to do 30, but my stop is clearly defined. Okay? There's a lot of different elements that come into it. And as I said, Elliott Wave is a lot of work. It's not a systematic way of trading. It's very much an art form. It's not a science. And if you have the mentality for it, I would pursue it. But if you don't, it's not for you. Okay? So this is just an ideal Elliott Wave progression. This is a downtrend. You can see waves 1, 3, and 5 are the trend waves. 2 and 4 are the corrective waves. You can see the 5-wave subdivisions in 1, 3, and 5, and the 3-wave subdivisions in 2 and 4. Okay? Is everybody cool with that? Any questions on the Elliott Wave sequence? Okay? So short-term trading with Elliott Wave, that's what I do. I primarily am my average stop loss size is about 25 points, 30 points, 40 points, pips in the currency markets. I'm a short-term trader. I'll hold a position for, it's like you said, I think you said a couple hours, maybe 15 minutes to a couple days if you're in a good trade. I'm the same situation. Currency trading, inherently it's going to be, if you hold a position for one full day in the foreign exchange markets, it's more or less equivalent to a 5-day trade in the stock market because the currency markets are open 24 hours a day. Stock market is open, 6.5 hours a day, times 5 is 32, 33 hours. So one 24-hour foreign exchange day is roughly, 2/3 to 3/4 of a full equity week. So you're going to find out that your time frames in foreign exchange are a little bit shorter just because there are more hours in the foreign exchange day. Okay, so you wind up being a short-term trader. With Elliott Wave, the Fibonacci, as I said, I can quickly identify my current market location. Okay, most important question you can ask yourself when you sit down on the trade desk every day is today a range or a trend? Okay, if you can identify that I believe in this situation we're in a range, you're going to set up your trading tactics in accordance with your anticipation that it's a range. Okay, if the market obeys or if the market unfolds the way you believe it will be, you should make money. If the market breaks away from what you think is the range and moves into a trend, you're going to be stopped out, but you're going to be stopped out for very little. If you sit down and commit, I say, I believe we're in a second wave, the market shouldn't move above this point, I'm willing to get short. If the market moves above this certain point, the old wave 1 high, my trend or my range is no longer valid. So there's your stop loss. By sitting down and identifying where we are in the range, you identify where your point of making your call invalid is. So the likelihood of an emotional response to a movement that was unforeseen is severely reduced. So if you can sit down and say, I believe today's a trend, or I believe today's a range. If you think today's a trend, you get short for the move down, the market moves above a certain point, it's easy, once you sat down to do the work, to say, okay, I'm going to step back, I'm not on the same page as the market, I'm not going to chase a breakout, I'm not going to do something stupid, I'm not going to try to buy the breakout above this old high because I have no idea where the market is. Okay? It's easy to allow you to step back and say, okay, I need to reassess. I need to find out where I went wrong and get on the same page as the market. Okay? For me, could be a pretty impulsive guy. Elliott Wave has helped me say, stop, you don't know what's going on, take a step back, write my strategy for tomorrow and say, guys, this is where we went wrong, this is what's going on, and this is where our next plan of attack is going to be. I look at everything. Everything, because
Gauge your range and trend. Are you going to longer term charts?
right now, it's interesting. As volatility increases, do you see yourself, I'm going to answer this in a long way. Do you see yourself looking at shorter time frames as volatility increases? Have you guys noticed that? So if you trade a 5-minute chart, if anybody's a euro-dollar trader, you get an average of a 40 or 50 pip move on an hourly chart in euro-dollar. Prior to 6 months ago, now you get a 50-point move on a 1-minute chart. Okay, it's your risk tolerance that determines what time frame you should be looking at. In an Elliott Wave count, if you're looking at a 5-wave sequence with an hourly chart, and you're typically in today's market, you're typically a 50-point trader, you know you need to move down to that 2-minute chart or a 5-minute chart or a 10-minute chart to see a 50-point move. If you're not prepared to using 200 pip stops or 200-point stop losses, using an hourly chart right now is not going to work. So it's two answers. It's one, what's your risk tolerance, and the risk tolerance fits on what time frame right now, and two, where are we in the count? Do you want to trade a wave 3 breakdown? Okay, if you're counting wave 3, if you're counting a 5-wave sequence on a 240-minute chart, you might need to get down to a 60-minute chart or a 30-minute chart to get in that wave 3. So use whatever time frame you want to see the count that you're counting. Does that make sense? Okay. All right. So identify the market emotions within different waves, and it keeps you in the direction of the trend until such time you have a very good reason to fight it. That's the best thing that you can do. Any trader. Doesn't matter if you're institutional, a fund trader, retail trader. Do everything you can to stay in the direction of the trend until you have overwhelming reasons. Take mine if you choose. To fight this trend. And when you fight this trend, the first thing you do is you decide, where am I wrong? You never fight the trend of a market. Get in a trade, get involved in the market, and then decide, maybe I'm wrong. Okay, and then decide where you're getting out. Before you get in a trade, even before you put the limit out to sell the top of a market, you decide where, if the market goes to a certain point, am I no longer right? Put your stop loss out first. I'll work with a stop loss all day. I'll leave a stop loss at a certain price all day, and I'll move in and out of positions trying to pick the top of a market. And I don't try to pick the top often, but when there's a certain situation it's appropriate, to get short a trend. Okay, I'll leave my stop there, and if the market goes through that stop, my count is wrong, and I need to step back. Okay, so let's look at Elliott wave, the basic 5-wave sequence. Just a couple rules within the trending market. Wave 3 can never be the shortest. Okay, wave 3 can never be the shortest, and 1, 3, and 5 must subdivide into 5s. Those are the only 2 rules in an Elliott wave trend. And you're going to need to know this for later. Okay? In the corrective sequence, wave 4 can never enter the territory of wave 2. I'll get to your question in 1 second. Wave 4 can never enter the territory of wave 2. Let's think about that for a second. If your corrections are overlapping, do you actually have progress?
No.
Probably not. You're not in a trend. So it's pretty smart. I mean, he's a pretty smart guy to say that waves 4 and 2 need to be dislocated for each other, which means this allows for a proper distance in wave 3 to signify that we have a trend. It's pretty easy. So 4 can't enter the territory of 2, and waves 2 and 4 must subdivide into 3s. So those are the rules of Elliott wave. 3 can never be the shortest. Okay? 1, 3, and 5 must have 5-wave subdivisions in themselves, and that's how you go to those smaller time frames to look within the internals of 1, 3, and 5. 2 and 4 can't overlap, and waves 2 and 4 must be 3s. That's Elliott wave right there. Okay? Just a quick, go ahead.
Can you explain in using more words, rule number 2, further or subdivide mean?
Subdivide, okay.
I understand what it means in real estate, but I'm not.
What does it mean in real estate? Subdivide?
Yeah, now you're playing with me. What does it mean?
Couldn't resist. Okay. Well, let me go into 2 corrections. And your timing was perfect on that question.
Thank you.
All right. What's your name, by the way?
Dwight.
Dwight. Todd. Nice to meet you.
You do it, exactly.
Just hanging out in Chicago. So I landed yesterday, and the pilot, I'm getting off the plane, and the pilot goes, "That was the windiest landing I've had in 12 years in Chicago." I was like, "Holy God." He said it was a 50-mile-an-hour headwind, which was good. Because he goes, if it was a cross current or a crosswind, we would have been in trouble. But it was 50 miles an hour straight on. So anyways. All right, so 2 Elliott wave corrections. We're going to look at 2. Okay? One is called a zigzag, and I know it's kind of a stupid name, but it's a zigzag. And the other one's a triangle. Okay? Another reason, I'm going to answer your question, hopefully in this slide. Another reason why I love Elliott wave is it assigns values, expected values, to very common technical patterns like pennants and triangles, ranges, uptrends, trend channels, whatever common pattern you see in the market, Elliott wave can give you expected values to where those values should end. Okay, so a zigzag, or what they call an ABC, is most often the second wave position. All right, and if you can't see, I don't know if you want to move up, just because you got to see within the internals of this. You're going to see that this is wave 1. This is wave 2, and this is going to be 3. So wave 2 most often is a 3-leg move. We get 1 down, 2 up, and 3 down. It's labeled with letters. Okay? So you get A, B, C. So wave 2, this whole move right here is wave 2. So within wave 2, you're going to get a 3-leg move. Okay? Break it down to the next step. All right? Now this might get a little confusing. The overall trend in this market is up, but within this wave 2's world, wave 2 in and of itself is in a downtrend. There's 3 legs in the downtrend. There's A down, there's B up, and there's C down. So within your zigzag, within your ABC, A is a 5, B is a 3, and C is a 5. Okay? The short-term trend of this zigzag is down. So the markets subdivide. Okay, it's fractal in nature, meaning you want to use all different time frames to understand what's going on in here. Does that make sense?
No.
Cool. So let's go on. Yeah, you know, I got to expect this. A sharp town like Chicago, you're not going to let me off easy. We'll get into some patterns in a second. Just stay with me. We'll get into some patterns. Okay. Most often, a 3-wave move is 2. Have you guys ever heard of a measured move?
Yes.
Heard of a measured move? Most often it's a zigzag. Okay. Another way to identify. If A is roughly equal to C, after your first 5-wave move off the lows, most likely it's a wave 2, and wave 3 is about to get underway.
Okay, thank you.
Like it?
What does subdivide mean?
Oh. Come on.
It says subdivide right there. Wave subdivided into 5 waves.
Yep.
The A and B is subdivided into 3 waves.
On the beginning of
And
2.
B and C is subdivided into 5 waves.
Show them the beginning of 2 and the end of 2, and the
Okay.
beginning of 4 and the end of 5.
All right. Well, let's look at some ride trade examples. Maybe it'll help. We got to.
Thank you.
I appreciate the help, guys. All right. So, if we think wave 2 is a zigzag, okay, most often this is the structure you're going to see in a wave 2 situation. Okay, you're going to get that big long wave 3, and then remember when I walked you through the 4th wave scenario? It's long and drawn out. Fundamentals are pretty powerful, but they're starting to decline. The people who missed the big wave 3 move are trying to buy the breakout of wave 4. They're trying to catch the next move. And usually, how many times do you buy a breakout and reverses against you? Buy a breakout, reverses against you. Buy a breakout, reverses against you. And as soon as you're out of the trade, that's when it goes. That's what a 4th wave is designed to do. It's designed to frustrate, pardon my language, the hell out of you. And that's what a 4th wave does. Many times in a 4th wave, this is where your triangle situation is going to unfold. Okay? A triangle, you're going to expect to have 5 legs. A, B, C, D, and once the E ends, once you can count 5 waves in a triangle, there's a decent chance that we could be coming to an end. You're going to have a downtrending up part of the triangle. You're going to have an uptrending downside of the triangle, so you're going to have converging lines. The markets are going to be getting tight. There's a battle within this. Buyers and sellers are transacting, getting increasingly aggressive. One of them is going to eventually emerge victorious, which would probably be the direction of a longer-term trend. So I'm really setting myself up for trouble here. But each of the 5 waves within a triangle do what? Into 3s. So I want to see 1, 2, 3 down in A, 1, 2, 3 up in B, 1, 2, 3 down in C, 1, 2, 3 up in D, and then once you can count, one more little 3-leg down in E. 5 is a very powerful Fibonacci number. Once you've got 5 swings from highs to lows, decent chance we're going to break. And I would say to you, never try to play a breakout from a triangle, I don't care where you are on the count, unless you can count 5 waves first within the triangle. That will save you many times of trying to pick breakouts, only to have the market reverse. Dwayne, I'm afraid to call on you. That was a good explanation. I got to tell you.
Are you saying that when you have an overall high versus a low, you can subdivide that into 3 and or 5?
Absolutely. Well put.
I got it, thank you. I don't know.
All right. How are we doing? Okay. Zigzag. Here we go. We're going to look in. This is our wave 2 move. Okay. Appears most often after extended trend moves. 1, 2, 3, 4, 5. We got 5s down and 3s up. 5s down, 3s up. This is a downtrend. All of a sudden, we get a little 5-wave move up. Something could be changing. Okay. Do we know this is the low? No. But it could be. So now we're going to look for evidence to say this could be a trap. Those who are trying to get short the breakdown might get trapped right here. So if all of a sudden you see 5 waves, you get an A, you get a B, and you get a C. A is roughly equal to C, and you're somewhere within the 618 and the 786 retracement. That's one of the most powerful entries in trading to bottom picking. One, because the market is heavily short. There's huge open short interest on this market. Everyone is overly bearish this market. And if you can count a 3-wave move down preceded by a 5-wave move up, this is one of the most powerful entries in the market between 618 and 786 retracement of this move, and A is equal to C. That's when the shorts start covering. That's when the breakout longs start getting involved. That's when the momentum players get involved. That's when everyone's getting involved. What's great about this trade is not only is there a lot of buying ammo about to step in the market, there's also very clearly defined risk. Okay? If in fact this is 1 and this is 2, the minute we trade below the beginning of 1, our whole count is wrong. So there's no reason to be in the trade. There's no reason to hope and pray that the trade is going to come back. Get out. So it defines clearly your risk, and it also puts you in a great situation to get on the same side of a lot of buying power that's coming into the market. Boom. Okay, as I just said, A is most often equal to C, and it's somewhere between 618 and 786 retracement. Okay, dollar yen, this is just a weekly chart. 1 wave, 2 waves, 3, 4, 5 down. All of a sudden we get A, B, C. A and C are equal into the 618 retracement. Very nice entry. That was the high in dollar yen 2 years ago. Okay, let's look at triangles. As I said, triangles happen most often in the fourth wave situation. They appear before the final trend wave. The final trend wave is wave 5, right? Okay, markets are bullish, comfortably long, almost complacent. Fundamentals are still strong, but not quite to the degree that they were in the third wave situation. Horizontal in slope, indicating a balance, a temporary equilibrium between buyers and sellers. They unfold in 5 legs. Each leg subdivides into 3 waves. Target following the break. This is traditional technical analysis. The distance of the triangle projected from the breakout. Or another Elliott wave touch is most often, once the triangle breaks, the break point will be somewhat equal to 0.618 of wave 3. Okay, it's one of those 2 targets. Okay, dollar yen, another dollar yen monthly chart. Wave 3 was down here in 1995. It came up from 220 yen to dollar down to 80. Okay, from 95 to 96. Remember we were talking about what happened from 97 to 2000. NASDAQ bubble, a lot of dollar buying interest, higher interest rates in the U.S., driving dollar buying, yen selling. But look, to the whole move up in 2000, it was 3 legs. This was wave 3 down. This market came from, this is, I know you can't see the scale, this is 80, this is 135, this is 150. Dollar yen came up from 220, way up there. So that's a wave 3. So we went up in 3, down in 3, up in 3, down in 3. So I got A, B, C, D. We're waiting for one more. A, B, C. So we've got 1 leg, 2 legs, 3 legs, 4 legs, 5 legs. Into trendline resistance, into 618 retracement of this leg, 120. Dollar yen broke 110 about 6 months ago, and we're down right here right now at 93. Just a real simple monthly triangle in dollar yen. I had this little move down after E broke. We shorted dollar yen. This is when the credit situation began. I had August, it started. I had some big months shorting dollar yen just after that triangle break. Okay, the fundamentals stepped into the 5th wave situation. Okay, the patterns in the last 13 years told us that this was going to be the high, and most likely we were going to break lower in wave 5. Then the fundamentals were kind enough to join the party, and that's when dollar yen is just getting crushed. So what's the target? Well, the wave 3 low was 80. So you know we're going to bottom somewhere below 80. Dollar yen's at 93 right now. So we got another 13 big figures to go until we retest the lows. Where should it go? I don't know, 70, 60? We've got a ways to go in dollar yen, which probably foretells that our current situation is going to continue for some time, because as dollar yen moves lower, stock markets will move lower, bond markets move higher. So just the wave structure and the way this has played out over the last 15 years in dollar yen probably tells us we're into this for a couple more years to go. Okay, so let's label the waves. 1, 2, this is so easy. Every hand better go up. What comes after this 5-wave sequence? Go ahead. ABC. 1, 2, 3. 1, 2, 3, 4, 5. Boom. That's a 5-wave sequence. Good. Okay, now, all the rules that I just gave you guys, which wave count is valid? Wave 1, 2, 3, or 4? And again, I need a hand just so I can give the book away. Which wave count is valid? Wave 2. What do you guys think? You think 3? I think 3. I think you might see a little overlap in wave 4 and wave 2. What's that? 4. I think wave 3 is the shortest here. What's wrong with 1? There's clearly overlap between 1 and 4. Or 2 and 4. So it's 2. Exactly right. Good job. Okay, just takes a little practice. Just takes a little practice looking at charts, and you'll start picking out the wave counts. Okay, so now we're going to combine them. We did of the full system, we did Fibonacci, Elliott wave. Now we're going to put the levels together. This is how we determine our trade entries. All right. So 6 questions of fuel. Is today a range or a trend? As I said, that's the most important question you can ask yourself before you sit down at your trading computer every single day. If it's a trend day and you're expecting a range, the likelihood of a costly emotional reaction to something you didn't expect is significantly reduced. If the market plays out the way you anticipated, it's likely that you're going to maximize your profits. If it doesn't work a lot. Okay? So what? As I said before, it doesn't matter. The best traders in the world are right all the time, but they're wrong all the time, but they're wrong for this much. Okay, there's nothing better in a situation, guys. It's such a liberating feeling to finally just be able to cut a loser. If you're in a trade, the market doesn't work, it's not playing out according to your wave count, just cut it. Get out of it. I don't care. I'm down 8 points in the trade. I don't care. Cut it. It's a really good feeling.
Are you defining the range as corrective and trend as impulse?
Correct. Absolutely. Range is synonymous with correction, and trend. What's your name, sir? Dan. Dan would say impulse is an Elliot wave terminology for a trend. So absolutely. We need to define, according to the rules of Elliot, where our range and trend boundaries are invalid. Once they're invalid, is there any more reason to stay in the trade? No. Cut it. Okay? How much will it cost to see those boundaries? That's your stop loss. Okay? Where are my range or trend objectives if my count is correct? Okay? How much can I make at those objectives? Is my take profit or my objective at least 1.5 times larger than my stop loss? If it is, we have a trade. If it's not, we don't. That's all it is. Okay? Just going to take you through a couple of strategies. This is my research report on the Forex.com platform. I got to read this disclosure. We're going to talk about live trades and trades that I actually did. So, the following are actual trades as recommended through Strategy of the Day. The following are successful examples. The unsuccessful trades can and will occur, as I've told you numerous times. Due to timing, strategy of the day recommendations, and actual executions vary slightly. Additionally, the spreads inherent in my performance are at generally more favorable rates than available to the typical retail investor. As such, you may not be able to achieve similar results as illustrated in this presentation. Okay? All that's saying is I trade through the managed account, I trade on the institutional platforms, I trade through the big investment banks, so I see slightly tighter spreads, but right now that's not the case. You guys are actually seeing better spreads than bank traders are. So.
We're seeing better spreads on
Yep. In most markets you are. Yeah.
because you're buying in such a large lot.
No, just banks are. This credit situation is really filtered into the liquidity in the bank market, in all markets. In the S&P market, in the floor, in the foreign exchange markets, you're seeing spreads widen out.
So I'll tell you what, this options, the volatility, these things are theoretical value, way overpriced.
Way overpriced, but is the liquidity there to get in and out of the trades?
Yeah.
Are the spreads wider than what they normally are?
Oh yeah, spreads.
That's what I'm saying. And the retail public the retail foreign exchange has grown so intensely in such great proportions. The retail is demanding tight spreads, and they're going to get it. You know, we trading on the institutional market, we can't demand those spreads. So we're seeing larger spreads. It's just a result of the credit situation. So, okay. So we're going to get into some strategy of the day examples. Just going to show you. This is a dollar-yen chart. This is last year. I need to update the presentation. This is one of my wave counts. This is a live chart at the time. This is a live count we were working. Okay, I'm just going to read you. This is Wednesday, December 19th, New York, 2:14. Okay, these are quotes right from strategy. I'm going to concentrate on this long position I'm working in this pending wave 5 breakout from our current wave 4 triangle. Okay, 3 down in A, 3 up in B, 3 down in C, 3 up in D. What's left? E and out. Okay, so we're long. I'm working in this pending wave 5 breakout from the current 4 triangle. The triangle should not let price below 112.70. 112.70 is the lower boundary of this triangle. So if in fact my wave count is correct, price should hold the lower end of this triangle support, 112.70. So I've immediately identified where the trade is no longer valid. So that becomes your what? Your stop loss. Okay, if it goes below 112.70, I'm wrong. There's no reason to stay in the trade. Okay, this triangle should not let price below 112.70 before we break topside resistance at 113.50 on the way to 114. So 113.50 is topside resistance in the triangle. 112.70 is downside support in the triangle. So, okay. Only long in an uptrending triangle. Yeah. Okay. And actually, we're already long. So the next day, Thursday, at 1 o'clock, we're already long from 113.25. Okay. I bought some. I thought this might have been the breakout from the triangle. So I bought some here at 113.25. And we're going to talk about adding to a position. And this is the first time I've mentioned this. Okay. I'm already long from 113.25. It's trade 113.00. So I'm 25 points in the hole here. I added more on the E wave push down to 112.80. Okay. I found out that this is in fact the E leg. So I'm long at 113.20. I decided, remember we said 112.70 is the boundary in this E wave triangle? We got a price at 112.80. Why not add more to the position? I've defined my risk. I know where the trade is no longer valid. I've not getting myself into such a large position that I can't add more while the trade is still valid. Okay, if you can define where a trade is invalid, feel free to add to the position so long as that price remains valid. Once it goes, that's when you get out of the trade. So I bought some here. I bought some more 112.80. I'm going to try to hold this break above 113.50 into 114.00. Back tonight. Okay. This was the next day on Friday. Our discipline and controlled aggression paid off handsomely. With our long Dalian position, we've been working for a few sessions now. The final target was met as we trade 114.11 bid as I typed. Profit potential in this trade was 120 points on initial 25 points of risk. Okay. So remember what I said on the triangle breakout. It precedes the final move, which is what? The final move is wave 5. So if we know this is obviously a fourth wave situation, we get the breakout from the triangle. What are we looking for within a fifth wave? You're looking for 5 smaller waves. Okay? So now we have 120 points of profit. We're obviously on the right page of the market. This is how you're going to begin to start picking the top of a market. Okay? The final Dalian target was met as we trade 114.11, 120 points of risk, 125 points of profit, 25 of risk. I'm nibbling on Dalian short side into the year end. Once we can count 5 of 5, so within our fifth wave, I need to count 5 smaller waves. Okay, I'm going to get aggressive on the short side. I'll be back in 12/24 before Christmas. Okay, so this is Monday, Christmas Eve. Okay. We can almost count 5 waves higher following the break from the wave 4 triangle. Remember, in Elliott wave principle, triangle formation is almost always in the fourth wave position, which means a termination push higher and wave 5 is left before the entire trend is reversed. I am offering in halves, which means I'm looking to get short at 114.55 and 75 with stops for everything at 114.95 and 115.05. Okay? All from your Fibonacci levels, retracements, projections, and extensions. Within the context of a fourth wave breakout, you can count 5 smaller subwaves. This is our point that we want to get short. Okay? It's very clearly defined risk. I've taken all the principles, everything I've got, everything I just gave you in the last hour and a half and put it into this one trade. Most importantly, we defined our risk. We already have 120 points of profit. The next day on Tuesday, this was Thursday actually, traders, we nailed the high in Dalian. We're filled short at 114.55 this morning. The market went only 10 points against us to a 14.65 high, and then we watched the market implode 100 points. So we got short here at the top, bought back in a simple trendline support for plus 90 points in the trade. You can see a little momentum. This is the only situation that you've seen indicators in this entire presentation is momentum divergence in a fifth wave situation. Okay, combined with your 5 wave of a fifth wave, triangle breakout, Fibonacci resistance. Okay, guys, that's how you pick the top of a market. Could it have not worked? Absolutely. But my stop loss was right there. I was risking 20 points to make 90. Go ahead. You're thinking.
Just quickly.
Yeah, Dan.
24-hour per day chart?
Yes. 20, showing 24 hours, yeah.
And is Forex open on Christmas?
No. Yeah, no. I don't think, half day maybe. Half day.
Do you use MACD in court conjunction with that?
I'm not much of an indicator guy.
Pick the bottom of the C or something? Or?
Sure, but by the time what's the only thing that makes MACD cross? Is price action.
Right, price.
With fuel, when you're combining Fib and Elliott wave levels, I want the bottom price because my stop is right there. You know, I want the price. I don't need for an indicator to turn up to show me that price is moving higher. I'm probably, by the time that indicator turns up, I'm probably already out of half the trade. My stops at break even.
Well, what I'm getting is sometimes in equities, I mean, you bring up a chart. I only trade plain as the nose on your face, but some of these things are so common, like J.P. Morgan. Try figuring a wave count on that thing. It's so crazy, you know what I'm saying? You'll sometimes help
You just answered your own question. If it's highly overlapping,
Yeah.
you're not in a what?
We don't know.
You're not in
You're definitely in a correction.
You're not in a trend.
Right, I understand that. You're definitely in a correction. I'm just, like you said, I play around with this stuff quite a bit. Matter of fact, I just got into deer because I looked at it, just going through charts. I said, well, you know what? I'm middle 3 right now.
Okay. If you can identify a 2 that's dislocated from a 4, the chances are you're in some kind of trend wave. So just use that simple filter and just concentrate on equities that are the corrections are removed from each other, and you're going to be in stocks that are moving. If J.P. Morgan's all over the place and not showing any progress one way or the other, probably no reason to trade it.
Yeah, I tend to watch sectors. If I like the sector to drop, then from there I
Okay.
try to.
All right.
All right.
So guys, thanks very much. I hope I introduced you somewhat to the world of Elliot. Some of you guys are very knowledgeable, and I appreciate that. If we could ever help you, again, I'm at forex.com. Open a practice account. You'll see my technical research there. I trade it. It's posted every day. If you have any questions, feel free to get a hold of me in any way, and I'd love to help you. Okay? Thanks, guys. And those guys who got the books, come on up, and I'll get your name and address.